Hello, and thank you for tuning in to this episode of the CRE Brief, your trusted news aggregator and analysis of all things real estate. First, let's talk about the debt issue looming over commercial real estate. In 2023, banks experienced a significant surge in distressed debt, particularly in the commercial real estate sector, as market downturns exacerbated financial strains. According to Trepp Bank Navigator data, the top 40 banks witnessed a staggering 154% increase in non-performing loans in the realms of commercial, multifamily, and construction loans, totaling $19.79 billion, up from $7.79 billion the previous year. This surge was mirrored, though slightly less dramatically, across the top 300 banks, where bad debts rose by 124% to $23.39 billion. The predominant stress was observed in the office sector, which has been particularly affected by the shift to work-from-home policies and rising interest rates. Alongside the increase in non-performing loans, banks also reported a significant uptick in foreclosed properties. The top 40 banks saw their holdings of such properties rise by 43% to $1.28 billion, with a similar trend among the broader top 300 banks, where foreclosures increased by 34% to $1.46 billion. The increase in foreclosures and distressed debt is symptomatic of broader market conditions, including lower property valuations and heightened borrowing costs, which have complicated refinancing and selling options for property owners. This situation is poised to worsen with a projection of around $277.6 billion in bank debt maturities slated for this year and another $283.9 billion for 2025, suggesting an impending escalation in banking sector vulnerabilities. Let's see how large this exposure is by state. In the banking sector, there's growing concern over exposure to commercial real estate loans. A significant portion of banks that have CRE loans amounting to 3 times their capital or more are concentrated in specific states. California leads with 31% of these banks, followed closely by New Jersey with 30% and Rhode Island with 29%. This geographic concentration highlights regional vulnerabilities in the banking industry related to commercial real estate investments. In the first quarter, lenders faced a significant increase in delinquencies on multifamily mortgages, which are bundled into securities known as commercial real estate collateralized loan obligations, CLOs. To prevent these bad loans from escalating and impacting their revenue from fees associated with CLOs, lenders have taken proactive measures by buying back the delinquent credits, according to JPMorgan Chase & Co. This resulted in the acquisition of $520 million in delinquent credit, marking a 210% increase compared to the same period last year. Now, onto some industrial news. Amazon is making a notable return to the industrial warehouse leasing market. According to several industrial REITs, Amazon is among the few large e-commerce and retail companies currently active in the leasing space. Amazon leased 4 massive 1 million square foot warehouses in Phoenix and the Inland Empire in Q1, along with nearly 20 smaller delivery stations. Amazon's current portfolio includes about 65 million square feet of facilities that are committed but not yet operational. The company has been restructuring its fulfillment network for better cost efficiency, regionalizing its operations into 8 smaller geographic areas, and planning to double the number of same-day delivery sites, adding approximately 50 new facilities near large metropolitan areas. In 2020 and 2021, Amazon aggressively expanded its logistics infrastructure. After a major slowdown in expansion in 2022, Amazon's recent re-engagement bodes well for industrial real estate. Let's talk international. Currency worries about the Japanese yen spark concerns after high recent volatility. Japan likely spent about $23 billion in latest yen intervention. Japan may have conducted its second currency intervention this week, according to a Bloomberg analysis of central bank accounts, in another sign of its intensified battle to prop up the yen. Tokyo's latest entry into the market was likely around 3.5 trillion yen, or $22.5 billion, based on a Bloomberg comparison of Bank of Japan accounts and money broker forecasts. Bear in mind that Japan continues to be the country with the largest holdings of U.S. Treasuries, with amounts totaling $1.1 trillion. Regional tensions in the region may contribute to further instability in the financial markets. Escalations could increase energy costs for Japan, forcing a selling of U.S. Treasuries to save the yen, flooding the market with supply, and raising U.S. Treasury yields. This could cause another wrench in the real estate capital markets. Well, this is the end of the CRE Brief for the week of April 3rd. Time to go back in the metaverse and have a digital beer. Make sure you follow us on X, formerly known as Twitter, and on YouTube as well. The handle is Cerebral, spelled C-R-E-B-R-E-A-L, like CRE for commercial real estate and real for, you got it, real estate, but with a B in front. This information is news being aggregated, optimized, presented, and sanitized for bias by artificial intelligence. I was your anchor, Mr. Paulson, but you can call me Robert.